They did it in the dark. On a Friday afternoon when most traders had already checked out for the weekend, the United States Mint uploaded a number to their internal pricing system. That number was $173. While you were watching silver bounce around $90 on your screen, while analysts were debating whether the rally was over, the government was making a confession. Not in a press release. Not in a testimony before Congress. In a database entry that they hoped nobody would notice. We noticed. The Proof American Silver Eagle. $173. The uncirculated version. $169. The spot price you see flashing on every financial terminal in the world. $90. Do the math. That's an $83 gap. The entity that issues the currency just told you their currency is worthless compared to the metal. They told you the paper price is a lie. This is the moment. The moment when the facade cracks. When the emperor stands naked in front of the entire financial system and pretends he's still wearing clothes. But here's what makes this absolutely explosive. The mint isn't selling. They shut down operations weeks ago. Sales suspended indefinitely. Pricing backlog, they said. Supply chain issues, they claimed. So why update the price? You don't reprogram a cash register in a store that's closed unless you're preparing to reopen. And you don't double your prices unless you know the world has changed while the doors were locked. The mint is preparing for the reopening. And they know what's waiting outside. A mob. A digital mob of millions of retail investors who just spent 6 months learning that silver is real money and dollars are confetti. When those doors open, if they open, the price will not be $90. It cannot be $90. At $90, the United States Mint becomes a fire sale. At $90, sovereign silver eagles would be arbitraged into oblivion within hours. So they front-loaded the repricing. They set the price at reality. $173. Now let me show you what was happening while they updated that database. 72 hours before the Mint uploaded that $173 price tag, something strange started happening in the Comex vaults. Not strange. Orchestrated. Friday, January 16th. A date that will be remembered. The CME warehouse reports dropped at 3 p.m. Eastern. These reports are usually 4 pages of mundane inventory adjustments. A few thousand ounces in. A few thousand ounces out. Background noise. This report screamed. 4.2 million ounces withdrawn in 24 hours. Let me put that in terms you can visualize. That's 130 metric tons. That's not a truck. That's a convoy. That's not a withdrawal. That's an evacuation. And it wasn't random. Look at the vaults. Asahi Depository, 1.4 million ounces. Gone. CNT Depository, 1.2 million ounces. Gone. JP Morgan Vault, 1.2 million ounces. Gone. Manfra Tordella Brooks, 800,000 ounces. Gone. Every major custodian in the Comex network got hit simultaneously. This wasn't organic. This was coordinated. This was planned. But here's the part that proves this was a heist and not a coincidence. That same Friday, the paper price got absolutely demolished. Silver crashed from $92 down to $86. A $6 freefall in minutes. Stop losses triggered. Panic selling. Blood in the streets. And while traders were staring at red candles, 4.2 million ounces walked out the back door. You think that's random? You think the biggest single-day withdrawal in Comex history just happened to occur on the same day as a $6 flash crash? Here's what happened. Someone needed to pull 4 million ounces. At $92, that costs $368 million. At $86, that costs $344 million. They saved $24 million by engineering a crash. $24 million. That's the cost of a hit. That's what you pay to manipulate a market long enough to loot it. They smashed the price. They loaded the trucks. They let the price recover. And by Monday, the story was already buried under new headlines. But we have the receipts. The warehouse reports don't lie. Now here's where this goes from heist to catastrophe. The total withdrawal was bad enough. But look at registered silver. That's the metal that actually backs futures contracts. That's the inventory available for delivery. That's the collateral holding up the entire paper market. Registered silver collapsed by 2.5 million ounces in one day. It's now sitting at 120 million ounces total. At the current drain rate, that's 30 days of inventory. Maybe 40 if withdrawals slow down. We're heading into March. March is the biggest delivery month of the year. Traders are already rolling contracts forward, demanding physical delivery in record numbers. The math is simple. The vaults are bleeding faster than they can be refilled. The registered inventory is disappearing faster than mining can replace it. And March is coming whether Comex is ready or not. This is the setup for force majeure. That's the legal term for when an exchange says, we can't deliver what we promised, here's cash instead, good luck. Industrial buyers don't want cash. Solar panel manufacturers don't want checks. Electronics companies don't want IOUs. They want silver. Physical silver. The kind you can hold. The kind you can manufacture with. And it's not there. So where did it go? 3 places. London, Shanghai, and private vaults that don't report to regulators. London is bleeding. The LBMA float is reportedly at decade lows. Shanghai is paying $12 premiums over New York spot. That's an arbitrage gap you could drive a freight train through. Every ounce that leaves New York makes $12 profit when it lands in China. The banks are playing 3-card Monte with global silver inventories. They're robbing New York to pay London. They're robbing London to pay Shanghai. And Shanghai is draining everybody. This is the end game of a 50-year suppression scheme. The paper price diverged from physical reality so far that the arbitrage became irresistible. Now the metal is flowing to wherever the real price is being paid. And the US Mint knows this. That's why the price is $173. That's the real clearing price. That's what you have to pay if you want metal that actually exists. But while the vaults were being drained and the mint was repricing, something else was happening. Something that makes this situation exponentially more dangerous. The retail public woke up. For years, silver was a contrarian bet. It was for preppers and gold bugs and conspiracy theorists. Respectable money stayed in stocks and bonds and real estate. That era just ended. We have data from institutional tracking firms showing something unprecedented. Retail investors have been net buyers of silver ETFs for 169 consecutive days. 169 days. That's 6 months of buying. Not a squeeze. Not a flash mob. A migration. In the last 30 days alone, $920 million flowed into silver ETFs. That's more than double the 3-month average. That's more than the 2021 Wall Street bet squeeze at its peak. But this time it's not Reddit degenerates gambling on a meme. This time it's your neighbor. It's pension funds. It's family offices. It's smart money that looked at inflation, looked at debt, looked at monetary policy, and decided dollars are trash. They're right. But they're buying the wrong vehicle. Most of that $920 million went into SLV, the iShares Silver Trust. It's the biggest silver ETF in the world. It claims to hold over 500 million ounces of physical silver in custodial vaults. The custodian is JP Morgan. The same JP Morgan that just pulled 1.2 million ounces from Comex on Friday. The same JP Morgan that is reportedly short billions of ounces in the derivatives market. The same JP Morgan that has every incentive to make the silver backing your ETF shares disappear. You see the problem. When you buy SLV, you're not buying silver. You're buying a claim on silver. A paper claim backed by a promise from a bank that's simultaneously betting against you. This is the ETF trap. It absorbs retail demand without actually removing metal from the market. The authorized participants can use leasing tricks, can use accounting gimmicks, can use fractional reserve alchemy to make it look like your shares are backed when the metal is actually in Shanghai. It works until it doesn't. And based on vault data, we're approaching the moment when it doesn't. Now let me show you the other side of this trade. The side that's about to implode. We have reports indicating that major banks are sitting on a derivatives book that would make your head spin. The gross short position in silver across Bank of America, Citigroup, and other major institutions could be as high as 4.4 billion ounces. 4.4 billion ounces. Global mining output is 800 million ounces per year. These banks sold contracts representing 5 years of total global production. They sold silver that doesn't exist. They sold silver that hasn't been mined. They sold silver that's still in the ground in deposits that haven't been discovered. This is naked short selling on a scale that makes GameStop look like a rounding error. And now they're trapped. On one side, retail investors pouring billions into the market, pushing prices higher. On the other side, industrial demand that doesn't care about price, it needs metal now. In the middle, vault inventories collapsing at 4 million ounces a day. If silver hits $100, the mark-to-market loss on 4 billion ounces is $40 billion. If it hits $150, the loss is $240 billion. At $173, the mint's price, the loss is $332 billion. That's not a loss. That's a liquidation. That's a wipeout that would require Federal Reserve intervention on a scale that makes 2008 look like a practice run. This explains the violence. This explains why they smashed the price to $86 last week. This explains the desperation. They're not managing risk. They're fighting for survival. But here's what makes this beautiful. Here's what makes this unstoppable. Every time they smash the price, retail buying accelerates. Every dip gets bought. Every manipulation triggers more inflows. They're trying to scare the public out, but they're only inviting them in at better prices. 169 consecutive days of buying proves the retail public is not selling. They're accumulating. They're holding. They're realizing that silver at $90 is the trade of a lifetime when the government says it's worth $173. The banks are trying to close a short position by driving the price down. But you can't close a short when nobody's selling. You can't buy back contracts when the other side is standing for delivery. You can't cover when the vaults are empty. This is the unstoppable force meeting the immovable object. The inflation-aware public versus the insolvent banking system. And the object that's moving is the vault inventory. The ETF structure was supposed to act as a buffer. It was supposed to absorb demand and keep it away from physical. But the buffer is breaking. The spread between paper and physical is too wide. The arbitrage is too obvious. The disconnect is too severe. When SLV says it holds 500 million ounces but Comex only has 120 million registered, something doesn't add up. When the mint prices coins at $173 but ETF shares trade at $90, somebody's lying. The paper price is the lie. The physical price is the truth. So let's talk about Monday. Let's talk about what happens when Asia opens Sunday night and this information spreads. Right now, this weekend, the news is percolating. The mint repricing. The vault drain. The ETF inflows. The short position. Traders are running the numbers. Hedge funds are recalculating exposure. Industrial buyers are panic buying before March. When markets open, we expect a gap. Not a small gap. A credibility gap. If the United States Mint thinks silver is worth $173, then every price below that is mispriced. $95 is cheap. $100 is cheap. $120 is still a 30% discount to replacement cost. This creates a rush. A front-running cascade. Everyone trying to get in before everyone else realizes what's happening. The paper market will try to resist. The algorithms will try to cap it. The short sellers will dump contracts trying to hold the line. But there's one problem. They don't have the metal. The vaults are at 120 million ounces and falling. The March delivery demands are at 200 million ounces and rising. The math doesn't work. The inventory doesn't exist. The game is over. This is the great repricing. Not a price increase. A recognition of value that was always there but suppressed by paper games. The paper said $30 for decades while central banks printed trillions. The paper said $50 while deficits exploded. The paper said $90 while inflation ravaged purchasing power. The physical always knew better. The physical knew that real money can't be printed. That silver is scarce. That demand is inelastic. That mines are depleting. That industrial uses are expanding. That solar panels need it. That electronics need it. That the future is electric and electric needs silver. The paper market was a dam holding back that reality. The dam just cracked. The US Mint repricing is the crack. The vault drain is the water starting to flow. The retail buying is the pressure building. And Monday might be when the dam breaks. So what do you do? How do you position for this? First rule, if you own physical silver, do nothing. Do not sell. I don't care if silver hits $100 Monday. I don't care if it hits $120 next week. The mint price is $173. If you sell below that, you're accepting a discount to replacement value. You're trading real money for paper that's dying. The temptation will be massive. You'll see your stack worth double what you paid. You'll feel rich. You'll want to take profits. Resist. This is not a trade. This is a transfer of wealth from the system to those who opted out. Don't opt back in before the transfer completes. Second rule, ignore the noise. They will try to smash it again. They will dump contracts. They will trigger stop losses. They will create red candles that look terrifying. Laugh at them. Every dip is fake. Every crash is manipulation. Every red day is a gift. The real market is in the vault. And the vault is empty. When you see a red candle, don't panic. Don't sell. Don't even think about selling. Just check the vault data. Check the registered inventory. Check the withdrawal reports. As long as vaults are draining, as long as registered is falling, as long as delivery demands are rising, the bull market is intact. The squeeze is active. The repricing is ongoing. Third rule, watch the spread. The most important number is not the silver price. It's the gap between paper and physical. As long as the mint prices coins higher than Comex prices contracts, the market is broken. As long as Shanghai pays premiums over New York, the arbitrage is active. As long as dealers charge $100 for an eagle while spot says $90, the shortage is real. That spread tells you everything. When the spread collapses, when paper and physical converge, that's when the squeeze completes. That's when the repricing stabilizes. That's when you can think about taking action. Until then, the spread is your signal. Wide spread equals opportunity. Narrowing spread equals resolution. Fourth rule, understand your exposure. If you're holding SLV, you need to make a decision. Not next month. Now. You're holding paper backed by promises from banks that are insolvent. When this breaks, when Comex defaults, when March delivery fails, the ETF will settle in cash. They'll say, sorry, we can't get the silver, here's the dollar value. And you'll get paid in currency that just proved itself worthless by repricing silver to $173. Convert paper to physical while you still can. While dealers still have inventory. While premiums are only $10 over spot instead of $50 over spot. Every day you wait is a day closer to force majeure. Every week you delay is a week closer to cash settlement. Every month you hesitate is a month closer to the moment when physical is unavailable at any price. The window is closing. We can see it closing in real time. Vault inventories. Delivery demands. Mint suspensions. These are not subtle hints. These are air raid sirens. Now let me tell you what the endgame looks like. The silver market is not going to gradually rise from $90 to $173 over the next year. That's not how broken markets resolve. They don't ease into equilibrium. They snap to it. What we're looking at is a discontinuous repricing event. A gap that can't be traded. A move that happens too fast for the paper market to react. Here's how it unfolds. Phase 1 is happening now. Vault drain. Mint repricing. Retail accumulation. The setup. Phase 2 starts Monday or sometime next week. The gap up. The recognition. The rush. Paper tries to catch up to physical. $90 becomes $100. $100 becomes $120. Short sellers panic. Margin calls trigger. Liquidations cascade. Phase 3 is March. Delivery month. The moment of truth. Industrial buyers demand physical settlement. The exchange realizes it doesn't have the metal. Force majeure declaration. Cash settlement. Market chaos. Phase 4 is the aftermath. Comex loses credibility. Shanghai becomes the price setter. London becomes irrelevant. Physical trades at massive premiums over any paper instrument. The world realizes that silver was always worth more than the screens showed. We're in phase 1 right now. This weekend. The quiet before the storm. Phase 2 could start in 48 hours. Are you positioned? Look, I'm not going to tell you what to do with your money. I'm not your financial advisor. I'm just a guy who reads warehouse reports and knows how to do math. But the math is screaming. The US government just told you silver is worth $173. They didn't announce it. They didn't hold a press conference. They just quietly updated their database and hoped nobody noticed. We noticed. The vaults just bled 4 million ounces in one day. They didn't announce it. They just published the warehouse report and moved on. We noticed. The banks are short 4 billion ounces. They haven't announced it. They'll never announce it. But the CFTC data shows it. We noticed. So now you know. You know what the government knows. You know what the banks know. You know what the insiders know. The question is, what are you going to do about it? Because Monday is coming. March is coming. The repricing is coming. And when it arrives, when silver trades at physical prices instead of paper prices, when the mint's $173 becomes the market's $173, there will be two groups of people. Those who bought at $90. And those who wished they had. The insiders already moved. The smart money already positioned. The vaults are already being emptied. History is being written this weekend. The month when the silver market broke. The month when 50 years of price suppression collapsed. The month when the United States Mint admitted the paper price was fiction. You're watching it happen in real time. You're seeing the confession. You're reading the evidence. The only question left is which side of the transfer you'll be on when the dust settles. The government tipped its hand. The vaults are bleeding. The banks are trapped. The public is waking up. And the metal is gone. Know what you hold. Hold what you know. And prepare for Monday. Because the game just changed. And the people who haven't figured that out yet are about to learn a very expensive lesson about the difference between paper promises and physical reality.